Martin Gilbert's here, Chief Executive, joining us live from the LSE. Good morning, Mr. Gilbert. Thanks for joining us.
Thank you, and good morning.
I mean, we've looked at the metrics. You've beaten on net income, revenue, EPS. You've even raised your dividend greater than the consensus. Just tell us how you've managed to achieve this.
Well, I think the overriding achievement is to do a good job for your clients. If you do a good job for your clients, the rest follows. And luckily, we are fortunate enough to employ some of the best fund managers in the world. So it's really all down to them. I have the easy bit to do.
Is it easy to retain those managers in these times?
It's easier than in buoyant times, but we've always had a pretty good retention scheme, which we're pleased to see a lot of other companies are moving to, which is to defer the bonus over 4 years rather than pay them out immediately. So that acts as a pretty strong retention tool.
The assets under management down 4% from last time. I think it's 169.9 billion. How do you explain that? I mean, is that anything to worry about?
Not really. I mean, most of it, of course, is market movement, which we have very little control over, sadly. Obviously, you don't like to see clients taking money out, but I think it's pretty normal when people have done sort of reasonably well in emerging markets, etc. And with all the news around, people are taking a bit of risk off the table. Hence, we're seeing more money going into our fixed income products than probably equity products at the moment.
Because you've been heralding Asian fixed income, haven't you? You've been saying investors should buy Asian bank shares and actually corporate bonds, if I'm right. What's the appeal?
Well, I think you want to lend money to people who don't need it, and we think Asian governments are in good shape. They're all the bulk of them are in surplus, and so it seems to us the obvious place to lend money to governments, and that coupled with potential currency gains, if their currencies do strengthen, make it a pretty attractive, low risk. I hate to use the word low risk, but attractive area to put your money, I think.
Martin, the big question, of course, is, I mean, how are you positioning yourselves in the event of continued turmoil in the Eurozone?
Well, I'm in the muddle through category and always have been. I don't really see the political will to break it up, and these may be famous last words, of course, but I do think countries like Greece would do better, even though there would be short-term pain if they did come out. I mean, we'd all flood there on holiday if that was the case, and but I'm definitely in the muddle through category.
Paint a picture very quickly, last question, for 2012. I mean, everyone's saying recessions all over the place. That's pretty grim stuff. How does that, what does it mean for you? Well,
I think the companies that we invest in, and we've had fantastic performance in equities, are in strong shape. They all have a lot of cash on their balance sheet. They've all taken out lots of costs during the recession earlier. And so companies are in good shapes and governments are in bad shape. I think that's the very simple situation we're in at the moment.
Martin Gilbert, Chief Executive Officer of Aberdeen Asset Management. Thanks for joining us today.